Hello, I got together with some friends to share some research, so this is a little bit of a longer video. I hope you like it. Today I'm reading International Value and Growth Stock Returns by William F. Sharp, who, just a little bit of a background, he is a professor emeritus at Stanford, winner of the Nobel Memorial Prize in Economics. He has a lot of influence on modern economics. And I looked into these two. I couldn't really find that much on them, so I kind of think that they're just like grad students. But, you know, thank you. So, as a quick overview of this, what we're talking about is the performance of value stocks and growth stocks over a long period of time in international markets. Now, in this intro right here, they just kind of define that the growth value, a growth stock is a company that has a low price to book measure. So, price to book is the main ratio that we're kind of looking at throughout this whole thing, and it's a part of the definition of value and growth stocks that they go over. And now what price to book means is that essentially it's the ratio between the price of the stock over what the company is worth by the book. And so that's what we're looking at. Now, things that have a low price to a high book ratio, I got it wrong in the beginning, but the thing that a value stock has a low price and a high book value. So essentially you can think of it as you're buying it at a discount, at a value. You're buying a part of this company at a value, it's on discount, the price is low compared to what it's worth, right?
How does this differ, or is it similar, like price to earnings ratio? Is that kind of in a way similar, or
a little bit? So price to earnings is a separate ratio that is very similar, except earnings isn't necessarily everything that the book value is worth. So it is very separate, or very similar, but it is separate. And a little bit of background on this I forgot to mention as well is that we're looking at 1981 to 1992. So this came out in 1993, this paper, and it was kind of all the hype for all of this, like price to earnings and price to book and value versus growth investor mindsets.
So this was right before like the burst of the dot-com bubble, right? Like,
yeah,
like
for sure.
2000, I think, is when it happened. 2001-ish.
Yeah. So we're starting to see just major growth, right? And so during this time, there was an idea that growth stocks should be held. Now, growth stocks are in this paper measured as a high price to book ratio. So it's a high price, but it's a low book, meaning or inferring that the book's going to grow into the price. That what they have right now isn't their potential. Right? So, or that's the idea. In this, they look at empirical evidence. I guess we can kind of move on, or we will in a second. In this, they look at empirical evidence talking about the performance between price and, value and growth stocks over a long period of time in, I think, 8 international markets. So these are just some glossary terms that they go over, and an efficient market is where prices just reflect all public and private information. we is like the US economy is in, I think it's called a semi-strong efficient market, meaning that there is some public or non-public private information that individual investors don't have access to. So there are some surprises, right? The market doesn't entirely reflect all information. Excess return is within that expected return using all publicly available information. Excess return is gaining anything over that. Monte Carlo simulation is just a way to simulate a lot of different random events. So in this case, we can get to it soon, but they used a bunch of different random iterations of price to book in their simulations, their performance simulations. Sharpe ratio. So this is something very applicable in risk-averse investors, and also the author of this paper that we're reading here. So the Sharpe ratio is optimizing your risk return. So just through like the minimum return that you want to get and the expected return that you want over how much risk that you're that you're being exposed to. This is a whole nother thing. I was thinking about reading this article explaining all of it, but I am just going to put it into a Google sheet that we can all share for if we want to read. And that like a library that we can have access to.
Is it similar to then kind of like because I know like a lot of like technical analysis like traders use like risk to reward ratio. Is that kind of in a way?
Yeah. So
like they usually have like a 2-to-1 where like you want to get $2 for every dollar that you put in.
Yeah, so we can even read this too, right? A measure of the reward obtained per unit of risk. So yeah, the amount of reward that you can achieve for how much risk you want to expose yourself to. Yeah, so it's similar, same author even. And there's something else called the safety first criteria, which is very related to this. That this is based off of. And that's also just super interesting. It's a way to optimize your returns for a minimal amount of risk, basically. Yeah. And so, I guess just moving forward here, I'm just going to go through these glossary of terms and then just go over the results, basically. Like, I'll go over how they got everything, but then we'll go over the results, and that's basically it. So, value stock, like the price to book ratio and the growth stock price to book ratio, that I went over. S&P Barra is just the S&P, and the Barra was just the popular index to use at the time. It's still publicly available. I forget what exactly it is, but it's within the S&P 500 universe. It's just a little more focused on value and growth indexes. T statistic, I'm just gonna read it because it's just a statistical value that they use in this, and it's the ratio of the difference between the observed and hypothesized value over the standard error of that value. And the greater the absolute of the T statistic, the greater the probability that the true value differs from the hypothesized value. So then it's just, to determine between hypotheses and null hypotheses, basically, is how they're determining that.
So it's like how accurate your hypothesis would be?
Mm-hmm. Mm-hmm. Okay. And how significant the results are. Yep. Value growth factor is just the factor of that, and then the value growth spread, which is actually what they are looking at. So we can kind of get into what they're doing here. So the value growth spread is just the return of the portfolio of value minus growth. And that's it. So a positive value equals a higher return from value stocks, and a negative value is a higher return from growth stocks. And so that's what they're doing. That's what they're measuring. They're measuring just the returns of a large index of value and growth stocks, and then they're subtracting them from each other. This goes over just how mutual funds are organized at the time, going over kind of the popularity of growth stocks. While we see the price to earnings ratios and the price to book ratios are pretty high for aggressive growth, relatively speaking, right? Like an equity income is a little bit more derived in consistency, not high growth stocks, right? And so you can see that these aggressive growth at the time have a lot of growth stocks, not value stocks, compared to more stable ones. Spoiler alert, we find out that the lower value, the value stocks have a higher earnings potential than growth stocks, but we'll get there. But the evidence is clear. So they took a whole bunch of stocks from France, Germany, Switzerland, UK, Japan, and the US. The US is weighted at 52%. The rest is split between those. Yeah. And they're talking about the correlation between all the different things. Sorry, indexes and markets.
So they have like a is there like you said, the price to book ratio? Is there like a number which states above this number is growth and above, or like I guess like, and below this is value?
Great question.
Yeah, not a big deal if we can't find it.
Yeah, unfortunately, I don't know. Hopefully, it comes up in the conclusion. But I'm sure the information is out there. Well, I do know that the percentage between them can get pretty high between the values. So now we're just gonna go over each of these graphs. There's like 8 or something of them for all the countries and global, and all the information, all the writing is just talking about what I'll be talking about. So I'm just gonna kind of go over each of the graphs. So here we go. We got the global one right here. So we see right away, by the way, the date is funky, but this is January 1981, January 83, 1985, January. Just so that, and then the Y is cumulative spread. So it's the value of the value minus the value of the growth, and in a percentage. And so we can see it's clear that these value stocks are earning a lot more, right? 40% more over time, globally, in all the markets tested. And to me, that's pretty definitive. But each country is a little bit interesting. So we start off with Japan, where in 1983 to 5, they kind of have this big boom of value stuff, but then growth stocks kind of take over real quick. But then, value stocks shoot back up. And in the US, it's a little less prominent, but it is still a little, I don't know if I could argue that is definitive. In the benefit over long run, but the trend definitely is in that favor.
So you said the y-axis here is the spread, which is value versus growth, right?
Yep.
Or I guess like the return of value versus the return of growth.
Yeah. Yep.
And so I guess, I mean,
A negative value would be
Growth or performing.
growth.
Yep.
Yeah. Growth outperforming value.
So the fact
Yeah.
that it's over 0 at all times means that value is still kind of giving better returns over growth.
That's correct. And that's really the case for almost everything. So in Europe, there is a small period of time where it does become negative. And I think the most pronounced one is in Germany. But in France, you know, this is a really interesting one. I think kind of went down around the beginning, but then it like stayed way up. But here, in Germany, so it does, stay negative for a good amount of time. We're talking close to 5 years here, that it's negative, and then it comes back up for about the equal amount of time. So where this has gone now, into the future, I'd be curious to see. But I'd be willing to guess, just on the trend of everything else, that this is Switzerland, by the way, that it is in favor of value stocks, right? Which also I think makes sense. So basically the conclusion that they come out to is that is correct, and that is significantly or statistically accurate, that the long-term earnings of value stocks outperform the value of growth stocks. And so I think that is makes a lot of sense, right? When you're talking about the value a company is going for versus what it's worth, right? It makes more sense that if you buy it when it's cheap, it's going to be worth more in the future. At least that's kind of what I think about it. And sure, there's an idea that something can grow into something else, but why would that be more reliable? I don't think inherently that it would be, but I can understand like getting into the mindset of that, of being like,
also kind of along the line of like, sorry to cut you off.
Oh yeah, I'll go.
Money now versus money later, right? Like you'd rather have the value by now than the potential of something being of good value later. Yeah,
and I think that maybe the sales pitch or whatever is that, hey, this company is about to blow up. You can capture the growth and then find the next company that's gonna blow up. Once it hits its equilibrium or whatever, then start finding the next company that's gonna blow up. But in reality, I think, they've proven that it doesn't perform as well in the long run. Yeah. And
so, again,
go for it. No. Go for it.
No, I think one thing also, this is, I guess, value in comparison with growth, right? That doesn't necessarily mean that like, hey, I'm just gonna pick always value, because I feel like value it inherently is cheaper, and it might be because it's just like not very like popular, or like it's just maybe perhaps like a small company, so like there's not that many investors, or like big investors that are willing to put their money in there. So and it can stay that way for many years. So I think that is kind of, in my view, the risk there.
I think that makes sense.
Whereas also, I guess, growth, it's like it's already like overpriced in a way, right? Like, or it's, by definition, it's overpriced. You're just, or at least at that moment, you're hoping that somewhere in the future, that it kind of tips over, where it's like not overpriced, or And I feel like kind of betting on that in the future, it might be like,
yeah,
I don't know, in my opinion, maybe not the greatest bet, as opposed to buying it cheap. And yes, it can stay cheap forever, just because it's maybe just unpopular, but yeah, it just seems like a smarter play to do that. I don't know, that maybe that's just my hindsight playing a role here.
Yeah.
After you've mentioned this.
Yeah, I think that something about it too is thinking about what actually has to happen to make a profit for both of them. Like, if there is a low value of, like, if a company has low value, but on their books it's maybe worth a little bit more, there might be a reason why it is low value, right? You know, you definitely have to take like an extra step, because earnings and like book reporting quality might not be, in fact probably isn't the same for every company. And so there might be a reason why they've got a low value. Well then, that's kind of, so I think that's kind of the bet with that, is more in the trust of running the company, while the other one is a little bit more in your trust in the company to achieve outstanding results, you know, bring their book up to their value, basically, right? And if you don't think that they can stand out and like go against the grain, then that's a risk.
Right. Yeah. And I think also to your first point, like, it might, like you said, everything isn't always like transparent, so it can be that maybe they're hiding something in their books that may not be like easy to see like right away, but maybe after you do some digging, it's like pretty obvious that they're hiding something, and you don't want to know what that is, and you just kind of stay away from it.
Yeah. So that's my article. If you guys got any more questions?
Yeah, I have one more question.
Yeah.
Can you speak to the role of this Monte Carlo simulation data that's played a part into these diagrams and results? So are these all real data from the market, or is this kind of like extrapolated as well? And to what extent does the...
That is a great question. So let's read here together. The Monte Carlos performed 100 Monte Carlo simulations for each of the 5 countries. Each simulation involved the creation of a set of indexes, one value, one growth. So this is, I believe, taking random selections from each index. Is how
like
it's
sub-index, basically.
Yeah.
Different combinations.
Yeah. I think that's what it's doing. And then it's taking the average of each of those results. So, does it say what kind of sampling it does? I don't see anything. But set of random numbers, the correlation, so that the correlation between the value and growth indexes would be only due to like the randomness of each subset.
Okay.
Yeah. So I do think that they used actual companies and actual stocks. But it looks almost a little bit more how they chose each one was through simulated processes. Yeah.
Yeah, I'd be really curious to see if there's a continuation of the study to the current day.
Oh, I'm sure there is. So, as we're on here, shouts out to William Sharp. On his Google Scholar page, he's got all his work. So he's got stuff, the earliest one I see is 2011. Or sorry, the latest one I see is 2011. Yeah. Increasing saving behavior through age-processed renderings of the future self. Yeah. So, that's it. I think final comments is, I think it makes sense, and all in all, I'd give it a decent read. That's what I'd say. It was kind of interesting, kind of good. It was relatively easy to get through and digest, and yeah, that's all.
Yeah,
Cool.
this is great.
Yeah.
Thanks.
Okay.
Are you like particularly interested? Like, were you particularly interested in like buying value versus growth stocks in like your portfolio, or is it just something that you kind of came across and like just thought it was interesting?
No, I've got it was a part of my CFA studyings, CFA readings.
Okay.
And I was like, I'm just gonna like actually read the article rather than just based off the reference. And I knew we were doing this, and I don't want to fucking read like the beige book, the Federal Reserve stuff. So I was like, let me find something else.
That stuff's exhilarating,
Yeah, I was looking at this one too. You guys can still see my screen, right?
Mm-hmm.
So this is that safety first thing, which is similar to the Sharpe ratio. And it's just about like optimizing safe returns in an investment portfolio. Which, of course, like, same with this, it's like, that's absolutely something that I do for my own portfolio. But, I can't say that I'm calculating, price to book all that much, for my portfolio selection. Yeah.
So, yeah, I was reading, like I think I mentioned, I read The Intelligent Investor, and I feel like there they kind of emphasize price to earnings, and I guess they don't mention ever like price to book. Maybe that's a term that was coined after the book was written, but basically they kind of state some similar like things that you mentioned here. I guess like book meaning like the assets that the company owns, and kind of how much, like if it was liquidated at that particular moment, how much would you get out of it, or like what would be like its total, like I guess like
valuation
it's worth. Yeah.
So yeah, I do think about that a lot, but it's also a lot for my own portfolio. I don't just have equities either, so it's like I've got a portfolio of good price to earnings, and like basically something similar to this equity income portfolio, something kind of like that. But then I also have like fixed income stuff and other things too.
Do you know if there are tools that measure this, like price to book?
Oh, for sure. Like every website.
Oh, really?
Yeah.
Because I know there's price to earnings, but I didn't know. Like I said, I'm. This is the first time I've heard of this price to book.
Yeah. But I thought it was on Yahoo. Because that's
maybe like
PDE.
have to, like specifically at like type in price to book and then like a ticker or something.
I don't know, Guru Focus, but here we go. Is this not?
Actually, I think
here we go.
Focus, yeah.
Here we go. Yeah. It's in statistics.
I see.
Yeah, and price to sales too. Value to EBITDA. I like this one too.
Okay.
Also
what
similar.
is that?
And her
sure.
value over earnings before interest, tax, depreciation, and amortization.
Shoot.
So just like value to earnings, right? Is before anything gets taken out.
Right. Okay.
Super similar to revenue. Yeah.
Cool.
Yeah.
Yeah, this is really interesting.
Dope. I'm glad. I think so too. So I'm glad you guys enjoyed it.